Marko, it's great to speak with you.
Thank you, Melissa.
Want to get your take on what's going on in the markets right now, because the gist of your most recent note is basically that everyone under the sun, from individual investors to CTAs, everybody is too bearish on this markets for various reasons. So what is happening now in your view?
So right now, today, obviously, the sell-off is related to the Eastern European news and the crisis over there. So that's driving it. That was also the case last Friday, But most of the volatility over the last 2 months was driven by the Fed, So you had this very aggressive repricing of the hiking path, sort of front-loaded hiking path. And I think that has largely upset the market. Add to that the crisis that we have in Russia, which impacted today and last Friday significantly the market, and what you mentioned, a lot of the capitulation from various investors. So you mentioned CTAs, vol targeters. Those exposures are down to basically around 10th percentile, so sort of 1 out of 10. That's where they are. So there was a lot of selling there as well. So we think it's a little bit overdone at this point.
So at this point, how are CTAs positioned? I'm asking because in the past we've seen a sort of a violent, I don't want to say correction, but when CTAs get over positioned in one direction, oftentimes that precedes a very violent and sharp correction to those positions. Are we going to see that?
So I think we would need to market to creep up a little bit from here to perhaps recover the losses from today, and we would be then in the zone of some of these levels being triggered on the upside. Right now, these investors are largely short. If you look at the NASDAQ, if you look at the small caps, and even the significant amount in S&P was sold there. So basically their positioning is now negative. If the market can recoup, let's say, today's losses, creep a little bit higher, which I think it will, then you could see the acceleration on the upside.
Marko, it's Sarah. Why do you think that this escalating conflict between Russia and Ukraine is not going to ultimately be a big negative factor for stocks when it seemingly only complicates the picture for the Fed, which is already dealing with inflation that's much higher than it expected, and now oil prices get even more elevated? Doesn't it just make for a trickier backdrop?
It is a tricky backdrop, but really Fed cannot do anything. If the oil goes up because of the war is not going to stop because of Fed. If the wheat and bread, food prices go up, people are not going to eat less and look at the check at the Fed funds to check whether they're going to eat one bread or one slice or two slices. So Fed really can't do much. So basically, if you already have a effective tax, which is imposed by, say, the war or commodity supercycle, kind of adding one extra tax at the top of that by no means will help. And hopefully these economists realize that. Economists typically, look at the models. They tend to be a little bit less focused on the markets and implications and complexities of certain situations like we have now, as I mentioned, with the geopolitical and some of the sort of structural commodity supply-demand issues.
So it sounds, Marko, like you like commodities and that the Russia-Ukraine tension can only provide upside to those trades. Is that right, that you like it either way?
That's correct, and we have been very consistent in that for the last almost 2 years. I would say energy and materials for the better part of the 2 years were our picks. Our top picks, partially it's a our super cycle thesis, which we talked about. Partially is, again, inflation, hedging, and partially is also reopening. We do expect reopening from coronavirus in the spring and summer to be pretty strong. So also on the demand side, we expect positive news there for these sectors.